Now that we've learned a bit about financial markets and opened an account, the first thing you'll notice is that we'll be working with a lot of charts. Not to worry though, they're not as complicated as your 7th grade math teacher tried to make them. In financial trading, we use 3 types of charts: line charts, bar charts, and candlestick charts. Line charts are the most basic. They simply map a line from one quoted price to the next. When linked together, they represent the general price movement of an instrument over a selected period of time. Here we can see the quotes for each day linked together in either green or red lines, green showing rising prices and red showing falling ones. Bar charts give us a bit more information about price evolution. Here we get closing prices for each defined time period. We also see the opening price and the highest and lowest prices over that same period. Here, the top shows the highest price, the bottom shows the lowest, while these little dashes show opening price on the left and closing on the right. Now, candlestick charts have become the most popular. They were invented by 18th century Japanese rice traders, and they show the same information as bar charts, but they're prettier. And because of their color coding, they're also easier to follow. Candlesticks show the open and close price in the high to low range with a vertical line. They differ from bar charts in their body. The width represents a particular time frame. Now, let's look at a daily chart where each candlestick represents one day of trading. Here, the body is green, meaning a bullish move. The price rose during that time frame. A red candlestick represents a bearish movement, or a close that was lower than the open. You can easily change the color scheme in your platform. Now, the next thing to consider is the chart's time frame. At the top left, here we see our options, from minutes, hours, and weeks to months. Each individual candlestick will represent the time frame selected. So here, each candlestick now represents one day or 24 hours of trading. If we change the chart to a 1-hour chart, each candlestick now represents 1 hour of trading activity. Now, 24 candlesticks represents just one candlestick on our previous one-day chart. Okay, let's take it a step further into trading. When choosing your time frame, you need to bear in mind several factors: your trading style, your other commitments, the nature of the market, and of course, the amount of money you're trading with. Some people prefer entering and exiting trades quickly, short-term trading. They'll look at market moves which can occur in a matter of hours. They'll invest in significant upward and downward moves. However, they'll have to be ready to monitor and assess the trading environment continuously. It's a full-time job. Most of us, though, have regular jobs and we have families. We aren't usually able to sit by the computer around the clock and watch the markets. In that case, medium and long-term trading is the way to go. But you have to be prepared to miss out on those momentary opportunities that occur intraday. The time frame is also a function of the size of one's trading account. You need to ask yourself if you have the margin required to hold a trade for a longer period of time. An asset may exhibit a specific trend in the long term with significant reversals in the short term. Here, a position can move significantly into an offside position that'll be closer to the stop-loss order. The position would then reverse into what would have been profitable. Keep in mind that there are no set rules. You might have short-term, medium-term, and long-term trades all running at the same time and all in the same market. Just make sure you've got your eyes open and your exit orders in place.